Right, so what I'd like to cover is the financial needs. What financial needs are out there? Why do we have a financial system in the first place at a very basic level? Who are the users of the financial system? I think we all have a pretty good idea, but let's get that on the table. What are the financial actors? What parties have a provider relationship to this system that we call finance? Who are the regulators? We're going to get into this in more depth tomorrow when we talk about the financial crisis and some of the things the regulators did not do and some of the reforms that have been put in place to make sure that a financial crisis like this does not happen again. But who are those regulators that we should know about? And then finally, this is a topic that's going to be covered in more depth, I believe on Wednesday. What is the global financial system like? Okay? So is that square with that? So very basically, all of us, all of business, government, have, it's called a three-legged stool, if you will. Three essential needs to interact with the financial system. We all need to save and invest. And if you save, you can either put it under your mattress, right, or in the top drawer of your bureau, or in a bank, or you can invest it somewhere, right? So you go to different providers to invest. So we need to be able to accumulate some wealth, right? So, but to live day to day, we need to be able to do what? Pay our bills. You save so you can live, right? And so living is expensive. Even as a colleague of mine at Boston University says, being poor is very expensive. Because if you're I don't know about here, but in Boston, if you live in a poor neighborhood, the grocery store that you shop at has higher prices than you can get at some other stores. So even being poor is very expensive. So even if you're poor, you need access to the financial system. So you need to be able to make payments. We need a payment system. And then the third leg of the stool is life would be very unpleasant if we knew that every time we had an automobile accident or a health issue or a death in the family or lost our job, that there was no protection against that risk that we all run just by virtue of getting out of bed in the morning. So risk management is the third leg of the financial services tool or need list. Who are the users of these services? Well, as we just went through, there are our consumers, us, all of your readers, individuals. Sometimes we call this retail, sometimes we call it consumers. And this is very important. We'll come back to this. There are commercial firms that go out and borrow from financial intermediaries. When you save money, you put your money presumably either in a bank or with an investment firm, and that firm turns around and lends it, typically to a commercial firm, either a large firm or what is called an SME, or small and medium-priced enterprise. So commercial enterprises need access to the financial system, both to borrow and for making their own payments, to do payroll, to pay vendors, so on. Institutional parties. I assume here in the Ukraine we have private universities that have their own endowments, millions, sometimes billions of dollars of funds that have to be invested and expended, right? The financial institutions themselves are institutional investors. So an insurance company, a bank, would be an institutional player in this system. And then finally, and I think this would be instructive for me to hear, many economies in this world, both developed and undeveloped, are bifurcated, divided in two, right? They have the formal economy, which is served by various providers that we're going to talk about on the next slide. And then they have the informal economy, where people don't have bank accounts, where people don't save, right? And they're not necessarily, not in every case, poor. They may not access the financial system for many reasons. Maybe they are poor, maybe they don't have the financial resources, maybe they're engaged in activities that they don't want anyone to know about, right? Or maybe they are subject to taxes that they don't want to have to pay, and if they surface as a part of the formal economy, it becomes a lot more likely that they will have to pay taxes. So this notion of the formal and the informal economy is a tremendously important dynamic. We did a economic development report for a Caribbean country in the last year, and fully half of the GDP of that country was made up, and it was a fairly large economy, was made up of informal activity. Remittances. Does anybody know what remittances are? Remittances? Well, we're probably more attuned to it in the U.S. because there's a tremendous outflow. If someone from the Ukraine immigrates to the UK or to the US, oftentimes they leave behind families to which they have an obligation or feel they have an obligation. So they send money back. And they send money back in the form of remittances. Just this very narrow subject of remittances, which is not on most people's radar, is an example of the informal economy, right? And I should have looked it up, what the amount of remittances flowing back to the Ukraine is, but I know in the case of this Caribbean country that I mentioned, it was like almost 10% of its GDP. It was $3 billion a year in remittances flowing back, largely from the U.S., but a significant part of the GDP, gross domestic product of that country. Yes, Dean? So who are the providers of these services? What is the universe of companies and firms that satisfy the three basic needs of savings, payments, and risk management? Banks. Now in the U.S., we have banks, commercial banks, which most people think of when they talk about banks, but we have a lot of near banks, companies that provide bank-like services. And these would be credit unions. Do we have credit unions here? Okay. We have savings and loans, sometimes called building societies. Do you have those here? Tomorrow, too, when we talk about central banks. Okay? Central banks are different from banks, commercial banks, private banks, in the sense that central banks are typically part of the government, right? And they play a much different role, but the interaction between central banks and commercial banks is critical in terms of monetary policy and the economy. Mutual funds. We do have mutual funds here, right? Have mutual funds? Do we have something called money market mutual funds? what is a mutual fund? And how is a mutual fund different from a bank? It's a pooling of assets by individuals, right, who come together to invest. Typically, it's for investment, not for spending, right? You would invest in a mutual fund as a means of savings, right? So by virtue of setting up a mutual fund, you, as a group, are then able to go out and hire an asset manager, somebody who is very sophisticated and very knowledgeable, in theory, about investing, somebody that you could never, as an individual, as one investor, retain, because you don't have enough scale. But combining your investment with thousands or tens of thousands of other people, getting together millions, or in some cases billions of dollars, then you can go out and hire an asset manager to manage that pool of funds and hopefully come out better as an investor. Two quick subsets, actually three quick subsets of asset managers and mutual funds. Number one is you can get all your assets together and you can go out and buy and retain the services of Paul Bowling, asset manager, and he's going to charge you $4 million a year plus a bonus for his services, okay? That's a little expensive, right? It raises the bar in terms of what this fund that you've set up has to earn in order to cover Paul's exorbitant but reasonable fees, right? You have to make $4 million plus his bonus before you make a penny, okay? These are called actively managed mutual funds. The alternative, or one alternative to that, is index funds, where you invest in a pool, right? And the pool declares in its offering document, often called a prospectus, that it's not going to hire a wizard to run this pool. Rather, it's going to invest in an index. It has an index of other things, right, that it is going to invest in on your behalf. You don't need a genius like Paul Bowling to do that. You don't even need a very bright person. All you need is a computer. So as a result, the fees, the investment advisory fees you pay for this type of a mutual fund will be very small compared to an actively managed. So actively managed funds, very expensive. Index funds, very inexpensive. And I think most studies have shown, and if I'm getting ahead of the game here, tell me in the back of the room, most studies have shown that overall investors are better off investing in an index fund than an actively managed fund. Overall, there are obviously exceptions. And then finally, there is this issue of money market mutual funds. Money market mutual funds, which are close competitors to banks in terms of the payment system. So you might invest in a money market mutual fund to have access to the payment system while at the same time earning more on what you have in the money market mutual fund than you would earn if you placed the same amount of money in a bank. So if you put your money with a bank, it earns zero today. That wasn't always the case, but it's zero today, or very, very, very close to zero. And yet the bank can take that money and turn around and invest it in the most conservative bonds at 3%, maybe. Right? So you don't have to be a genius. I pay zero, I invest it at 3%, I go home at 3 o'clock, I play golf. That's a good business to be in. But there are these things called money market mutual funds, which were developed in the 1980s that say, okay, put your money with us. We won't give you the same insurance on your deposit. You have deposit insurance here. If you have your money in a bank, it's insured by one of these schemes. If you have your money in a money market mutual fund, it's not insured. You run something of a risk. Right? The trade-off is that the money market mutual fund goes out and invests in short-term, high-quality, very liquid investments, right? Such as commercial paper, government bonds, very, very, well, government bonds are less safe than they used to be, we know, but this is the theory. And when money market mutual funds were begun back in the 1980s, they had to be a separate category. They couldn't be regulated as normal mutual funds. A normal mutual fund, whether it's an index fund or an advised fund, goes through a process where every day at 4 o'clock, they look at the portfolio, right? And they calculate what is known as the net asset value, NAV, of that fund. So if you own a mutual fund, index or advised, every day you can read in the paper or online the net asset value of that fund, and divide that by the number of shares outstanding, and you know the value of your investment. Okay? With respect to money market mutual funds, however, the money market the mutual fund industry sold to the SEC, one of the agencies that we're going to get to here on a later slide, the concept that, oh, don't make us calculate the NAV every day. That would be too cumbersome. We are just going to assume, because we only invest in short-term, high-quality, liquid instruments, we're just going to assume that the value of our portfolio is $1. That every dollar that you invest in a money market mutual fund is worth $1. We're going to assume that. Well, in 2008, when there was a massive liquidity crunch, credit crunch, guess what? They weren't worth $1. And guess what also? The smart money, who knew that, and I say smart, having awareness of this, having an hour or two lead on everybody else, withdrew their money from the money market mutual funds. And hundreds of billions of dollars of this, at the time, $3 trillion industry was sucked out, right after the collapse of Lehman Brothers. Right? So even though money market mutual funds are a close competitor to banks in the sense that they provide a payment mechanism, because you can write checks on mutual funds, you can make transfers out of mutual funds. Many people consider them cash equivalents. They are most definitely not the same thing as banks. Ability to lose your entire deposit and ability to lose principal. in your investment. Makes some difference. Investment banks. This is an interesting case. I wish banks was not appended to the word, the term investment banks. Investment houses would probably be a less confusing way to refer to these entities. Investment banks are, until recently, not banks. They're like banks. They provide a lot of banking services, but they're not banks, again, until recently. So before the crisis, the major investment banks were the likes of Goldman Sachs. We've all heard of them, right? Goldman Sachs. Morgan Stanley. We've all heard of them. Merrill Lynch. If you're a commercial enterprise and you, sure you borrow from banks, but now you want to access the capital markets, right? You want to issue stock, right? Or you want to issue bonds that Paul is going to be talking to you about. You would go to an investment bank to do that. Why to an investment bank? Why not to a bank? Because it's the investment bank that has the infrastructure, the contacts that can distribute that accessing the capital markets in something called an underwriting. Investment banks also provide investment advisory services, and they help arrange mergers and acquisitions. Structurally, and this is what I meant when I said that so much has changed in the recent past that it's not that hard to catch up. You know, we're not talking about centuries of learning. A lot has happened just in the last 30 or 40 years. So back as late as the 1990s, these major investment banks in the US, and perhaps the one that we're mentioning in the Ukraine, were organized as private partnerships, right? Where the principals in the firm owned the firm. So has anybody ever heard of Hank Paulson? No? He was the Secretary of Treasury in the U.S. during the financial crisis, and prior to that was the CEO of Goldman Sachs. How about Robert Rubin? Probably haven't heard of him. He was the also the Secretary of Treasury in the Clinton administration. Prior to that, a partner in Goldman Sachs. And why do I point that out? Well, as a private partnership, each of those individuals and many hundreds of other partners had what is known in the industry as skin in the game. Do you know that expression? Skin in the game? Skin in the game. It's a slang term, but basically what it means is that you stand to lose, you personally stand to lose, depending upon the success or lack of success of the firm. You have skin. It's I think it's derived from gambling, right? Money is referred to as skin in the game. And if you have money on the table, skin, then you're invested in that. As opposed to not having skin in the game, where you're just dealing with other people's money. Okay? Well, along about the 1990s, particularly the late 1990s, the major investment banks went from being private partnerships to doing IPOs, initial public offerings, becoming public companies, where the partners no longer had skin in the game. It wasn't their money anymore. They were dealing with other people's money, just like banks deal with other people's money. Other people's money in the form of your deposits and my deposits. Right? a very important point when you're thinking about the financial system. Does the party at the table have skin in the game? This issue came out in force through the financial crisis. Securitization basically means taking a whole bunch of assets, usually in the form of mortgages, but it can also be credit card receivables or automobile payment receivables. Taking those assets, putting them into a pool, and then selling pieces of it, right? This was the financial engine, this securitization process that was the fuel for what some people call the subprime mortgage crisis that started in the U.S. but was actually going on in many, many other countries at the very same time. This mechanism by which you could pool large amounts of debt, which is an asset on the books of a bank, it's an asset. To you, the customer, it's a debt, it's a liability. Pool all those assets and then sell them off in various what they call tranches, layers of risk. What does this have to do with skin in the game? What it has to do with skin in the game if I am putting this pool together and if I don't have any investment in that pool, do I really care whether that pool is of high quality assets, or do I even care whether the representations that the pool makes to potential investors is accurate or not if I don't have an investment? If my only connection to that pool of assets is that I get a fee for putting it together, if I'm Goldman Sachs and I get a fee for putting that pool together, but have absolutely no risk, no skin in the game, then what do I care what the quality of those assets is? What do I care if the prospectus says these are wonderful mortgages and they're not, as long as I get my fee? Okay? So investment banks are still an important part of the financial services provider community, but the major part of the investment bank industry has changed as a result of them becoming public companies, not answering to themselves anymore, but rather to distant shareholder owners, right? Where the partners no longer have skin in the game. Insurance companies, longer term perspective, right? They're out to make sure that our lives, our financial lives, go on in a more reasonable way. Right across from the hotel, I noticed there's an office for AIG. AXA is also there within a stone's throw of the hotel where we're staying, two of the major insurance companies in the world. Has anybody ever heard of AIG? Good company, right? One would have thought, yes, right, in September, early September of 2008, one would have said, AIG, the largest insurance company in the world, not in the U.S., in the world. And a month later, it's being bailed out by the government. But more on that later. So insurance companies are important providers, important institutional investors. And then those of you that are so fortunate as to have access to your own significant pools of wealth can go out and invest in hedge funds and venture capital firms and private equity. These are separate kinds of vehicles that we'll probably get into later in the program, so I won't spend a lot of time on them, although they are very important. We're also going to talk about later in the program about the shadow banking system, all right? These money market mutual funds, the third category of mutual funds that I described to you, are part of the shadow banking system, as we refer to it. Why do we call it shadow? Because it exists off to the side. It's not regulated in the same sense that a bank or an insurance company or a normal mutual fund would be regulated. It's more free form. Now, people that practice in the shadow banking system will tell you in a minute that, oh, we're subject to all kinds of regulations that others are not. But when Joanna is not here anymore, but she's going to be talking, I believe, about derivatives, is she not? This is part of what is known as the shadow banking system. Who knew before 2008 that there even was a shadow banking system, right? The Fed, Federal Reserve, Central Bank of the U.S., may have known about it. They certainly did know about it, but they certainly, at the same time, did not regulate it, nor did they send up any alarms about its existence. In fact, quite the contrary. I remember the former chairman of the Federal Reserve, a man whose name you may be familiar with, Alan Greenspan. You ever heard of him? Also, at one time on the cover of Time magazine, referred to as no, the maestro. He was the maestro. He was the genius. He was the one that led the band. He made the economy of the world hum until it didn't hum anymore. And then he had to testify before Congress, excuse me. And I don't, have any of you had a chance to watch the movie Inside Job that was assigned? I hope you will. It's an Academy Award winning. And there's a clip in Inside Job of Alan Greenspan testifying after the crisis. Alan Greenspan was a libertarian. Does everybody know what a libertarian is? Libertarian. You know, no government, get the government out of my face. Shadow banking is good because there's no government regulation here, because I'm a libertarian and I don't believe in regulations. So ergo, therefore, if there's an institution that has no government involvement, it's got to be good, right? So here's Alan Greenspan, the chairman of the Federal Reserve for 19 years, testifying before Congress saying, gee, you know, upon further reflection, I think my entire philosophy of how the economy works was wrong. 19 years, he's running the economy, he's the maestro, he's throwing his back out, taking bows for doing such a wonderful job, and his entire philosophy was wrong? How can that be? Well, he thought that private actors that had skin in the game, their own money at risk, would exercise what is known as market discipline. Okay? You might want to write that term down. Market discipline. Because market discipline versus sound regulation is the global battle in which we are engaged. Market discipline, as believed by Alan Greenspan and still others, versus sound regulation. I don't know how this is playing out in the Ukraine. I do know how it's playing out in the U.S. To a lesser extent, I'm familiar with how it's playing out in the EU, but this is one of the major battles of our time. Shadow banking system. Okay, who are the players? I'm not going to spend a lot of time on this because we're a little late, but we've already mentioned the Federal Reserve. The Board of Governors of the Federal Reserve System has two roles. It was created by Congress in 1913. That's coming up on its 100th anniversary. Happy birthday, Fed. It has two roles in the U.S. Monetary policy, regulating the supply of money and credit in the system. And then the second one is banking regulation. In the U.S., the Federal Deposit Insurance Corporation and the Federal Deposit Insurance Fund is the provider of insurance for deposits. In the U.S., we insure deposits up to $250,000. The FDIC also has a very important role supervising and regulating banks, right? In the U.S., we have what is known as the dual banking system. Dual banking system. In other words, we have 50 separate states, from Massachusetts, which is the best state in the Union, some would argue, to Hawaii, to Alaska, home of Sarah Palin. Anybody know who Sarah Palin was? So if you want to form a bank, you can either go to one of these 50 states and charter it there, or you can go to an agency in Washington called the Comptroller of the Currency, and you can charter it there. Comptroller of the Currency was established in 1863. That goes back a ways. 1863. To establish national banks to help pay for our Civil War at the time. Guess who signed the law establishing the Comptroller of the Currency? Your friend and mine, Abraham Lincoln. Anybody seen the movie Lincoln? Why would you, right? Good movie. So state banks, national banks. I mentioned the Securities and Exchange Commission, right? This regulates the markets. If I want to register shares, I register them for sale for a public offering at the SEC. It also has a significant role to play as a result of the reform law in the U.S. known as Dodd-Frank. It has a significant role to play in the regulation of the derivatives market. More to come on that later. If you also, it shares that authority with another previously obscure agency called the Commodities Futures Trading Commission. Did anybody watch The Warning? Quote, The Warning, a PBS show. It's only about 50 minutes long. It's about a woman who was the chairman of the Commodities Future Trading Commission and how she was bullied and mistreated in the late 1990s. Why? Because she had the guts to suggest way back then that derivatives were something that maybe we ought to study. Just study them with a view to maybe down the road regulating them. I urge you very much to watch that, particularly from a journalistic perspective. You know, the same thing with Inside Job. I think the lessons that you can get from these two documentaries are significant. We'll talk more about that. The Treasury Department of the U.S., an executive agency, now has very substantial regulatory and oversight responsibility by virtue of being the chair of something that was set up by the Dodd-Frank law called the Financial Stability Oversight Council, which is our attempt to deal with or eliminate risks. And then a new agency on the scene called the Consumer Financial Protection Bureau. On the U.S. stage, we have Basel, which is it's more than just a city in Switzerland. It's kind of the superstructure for global coordination of efforts within the Bank for International Settlements, BIS, right? And we have two components to Basel. We have the Basel Committee on Banking Supervision, which comes up with guidelines for the rest of the world, including the Ukraine, guidelines, not rules, but guidelines for capital. And the most recent guideline is called Basel III, 1, 2, 3, Basel III. You'll be reading about that. And then the other part of it is something called the Financial Stability Board, which does its work under the auspices of the G20. The G20, the 20 developed countries, they constitute about 85% of the world's GDP. And together, they issue broad guidance to the Financial Stability Board, asking it to carry forward mandates to stabilize the financial system of the world. Well worth paying attention to. Just by coincidence, the head of the Financial Stability Board right now is a gentleman by the name of Mark Carney, formerly head of the Central Bank of Canada, and as of about, Paul, a month ago? Now the head of the Bank of England, right? So he's had a pretty good run. And from all I've heard, he's a very, very sophisticated and good central banker. We have the European Central Bank that we'll be hearing more about. We have the Bank of England, I mentioned, which has now taken over from an independent agency, the Financial Services Authority, bank regulation and supervision, and they divide that into two parts. The Prudential Regulatory Authority, which tries to make sure that the safety and soundness of all banks under the Bank of England's jurisdiction, that is the condition of those banks, is sound. And then the Financial Conduct Authority, where they try to make sure that the way that these banks deal with each other on a transactional basis and deal with customers is also reputable. And then we have various forums, where regulators from countries in those three product areas that we mentioned, investment, banking, and so on, come together and share best practices, regulatory standards, and whatnot, where the securities, the SECs of the world come together is in something called IOSCO, International Organizations of Securities Commissioners, like that. The insurance people come together in this organization, IAS, International Association of Insurance Supervisors. And then one thing that I put up there that you should be aware of, because it's so important, is that accounting, almost everything that we deal with in this area has an accounting aspect to it, right? So, for example, has anybody ever heard the term mark to market? Mark to market? Mark to market. You might write it mark hyphen to hyphen market, right? It's a very critical term, because if say I'm a bank and I make a loan to you, and you're saying, why would you make a loan to me? Right? But I would suppose I do make a loan to you. On day one, that loan is worth what? $100, right? I have an asset on my books, a loan to Natalia for $100. However, suppose I find out, sadly, that you lose your job, right? Is that loan still worth $100? I may be carrying it $100, but I know that your source of income to pay off that loan has gone away. So probably, and if I tried to sell that loan in the market, and the prospective buyer did something called due diligence, which is another word for research, they would soon find out that you had lost your job. So they're not going to pay me $100. They're certainly not going to pay me more than $100, which would be a premium based upon the interest payments, the future stream of interest payments that I would get from you, they're going to offer to take that loan off my books at a discount. A discount. Pay me maybe $25, right? And then chase you, right? But meanwhile, the bank is carrying that loan for $100. Well, if I were to go through something called mark-to-market, I would have to go to my accountants and my finance department and say, hey, in order for our books and records to be accurate, we have to write down this loan. In other words, even though we're not selling the loan, we have to take a $75 or whatever, a $75 loss. Ooh, that hurts. $75 loss. If you multiply that through an entire portfolio, and if you're going through a financial crisis, bad news, right? When you have to market, there are 3 ways that you can determine market. The first way, probably the preferred way, is that there is a market in the securities that you hold. There probably isn't a market in loans to you, but there is a market in loans to the city of Cambridge, right, for example, bonds. So if you have an empirical market that you can point to as the value, then level 1 is the mark-to-market value that you would use. Absent that, you have to go into the market and find specific transactions on your own and figure out from those what the value is based upon real live trades. So the best would be an exchange listing or some third-party listing of the value of securities. Second best would be based upon actual transactions that you could point to. And then finally, and this is where the financial crisis occurred, when everything seizes up, when there's no trading anymore, when you can't buy or sell anything. There's no exchange prices, there's no prices that you can point to. You have to just make it up. Make it up. Sometimes they call that mark to model, right? So in other words, the financial institution will have a very sophisticated model that will demonstrate what it thinks the value of those securities are, right? Well, that brings us to the question of trust and confidence. Run on the bank. Okay, suppose you didn't have your deposit insurance. Suppose there were no deposit insurance. And you heard a rumor that the bank that you had your deposit in was insolvent. That bank was not marking its assets to market and was hiding the fact that its liabilities exceeded its assets. That it was going to close tomorrow. What would you do? Would you? No, as a depositor. Would you? The question is, would you walk to that bank or would you run to that bank? The rational thing to do is to run to that bank and hope that you're faster than all of the other people that are running to that bank at the same time because they know, right? Very, very frightening thing. Right? Now, my career in this business spans more years than I'd like to admit. I'd always read in the papers about runs on the bank, but I had never really experienced one until this crisis. Right? We had run instances where even though there was federal deposit insurance or the deposit insurance that the UK provides, even though that was in place, there were runs on the bank. I'm thinking in the US of one of the largest banks at the time, Washington Mutual. I don't know, 500 billion in assets when it failed, something like that. 500 billion, that's a big bank. But it failed. And for 10 days, there was a run. People were running to the bank to get their money out ahead of other people. In England, Northern Rock, right? Run on the bank until it was rescued. Suppose you don't have the confidence that even if you run to the bank and you take out, I can never pronounce the word. What are these called? Rigna. And these are dollars. See, our currency is obviously worth more than yours because it's that much bigger. Right? So what if I ran to the bank and I withdrew all my Rigna, but this wasn't worth anything? What's the point of the run then? Because I'm just left with paper, right? So what makes you think that this is going to be worth anything? What gives you the trust and confidence that your Rigna is something that you can pay your electricity bill with tomorrow? But what if I don't have any confidence in the central bank of the Ukraine or in the Federal Reserve, or that the dollars or Rigna even carry what is known as the full faith and credit of this country behind them? In other words, what if I don't believe that the authorities here or in the US will exercise their taxing authority to go out and raise the amount of money by force, if necessary, to ensure that these currency, these Rigna, those dollars, can be used? That the counterparty that you tender this to has to take it. Trust and confidence. It's so vitally important to the financial system. And not to make too dramatic a point of it, but it is your role. It's my role as an educator. It's your role as journalists to ensure that that trust and confidence is maintained. Not by reporting falsehoods, but by reporting the truth. By ensuring that there is transparency. Sure, we have deposit insurance, and we have central banks that can lend to financial institutions to get them over a momentary crisis. And we have supervision of financial institutions on a daily basis. And we have capital requirements coming out of Basel and our own regulatory authorities. We have the reputation, and we have the perception of your loan being valued at what it is truly worth. All of this is very important. But all of this depends upon transparency. All of this depends upon how you communicate it to the various stakeholders in this country. All right? Illiquidity, insolvency. Do we all know the difference? Illiquidity simply means that I don't have the Rigna in the teller's cage to pay you. I can get it because I can sell some assets. I can take your loan and I can sell it for maybe $90. I can get it for you tomorrow, But today, I don't have it, right? I don't have the liquidity. Insolvency, however, means either I cannot sell that loan, or if I sell that loan to another party, and the sum total of selling assets exceeds my equity, now I'm insolvent, right? Assets equals liabilities and equity. If equity goes down, you reach a situation where liabilities exceed equity. That's called insolvency. So one of the things we try to do is, as regulators, we try to make sure that they have capital at a certain level. This is being debated intensely across the globe now. What level of capital banks should keep and what type of capital. But for the moment, we'll keep it very basic. The capital ratio equals capital as the numerator. Do we know this? Are we okay? And assets being the denominator. Divide one by the other and you get a percent. And that is your capital. Okay? Capital divided by assets. So what I want to talk to you about tomorrow and what I want to have you talk to us about is what are the impediments to transparency here? What are the things that help you understand what's going on in your financial institutions? So the impediments and the things that help you. So these are the questions we're going to pose tomorrow. If you don't have to write them down because I'll reread them. But is the Ukrainian banking system transparent, either on an absolute basis or on a relative basis? And I'll ask you in groups to answer that question. What features of the system contribute to it being either transparent or non-transparent? In other words, it's not enough just to say, I don't have a clue, right? I want to hear specifically what it is that makes it transparent or non-transparent, and then let's come up with our own remedies for enhancing transparency. Okay? So I apologize for not getting into this exercise today because I think it'll be very useful, but I think on further reflection, I think you're having the chance to talk about it in the hallways and maybe think about it overnight, particularly if you take me up on it and watch The Warning and the movie Inside Job. They're both very, although they're documentaries, they're very entertaining. You've seen both, okay? Right? Would you back me up on that? Yeah. Yeah. It is just a marvelous piece of journalism, and entirely, I think, not entirely, but largely accurate. So I think you're watching those tonight, late, and then coming back tomorrow and having this discussion about transparency will be simply marvelous.